we've seen a little bit of volatility return to the currency, nothing out of the ordinary for sure, and perhaps it's a good thing. But is there reason to believe that the conditions from last year will change dramatically this year? That huge surplus, which the RBI had to keep absorbing, now with US yields rising, etc., could there be a sort of different dynamics playing out on the currency this year?
You see, that's very obviously the case when oil price is at whatever between $20 to $40 a barrel. Your current account balance comes down quite dramatically. The second thing that was happening last year is we had the most severest lockdown, right? At least all the way up to say July or so, which means given that you are a trade deficit country, your imports fall faster than your exports because the rest of the world is more open. So both factors combine to make sure that your trade balance became zero, or in some months even became positive, and current account became surplus. And then on top of that, you had significant amount of portfolio as well as FDI flows. And I think RBI did the right thing by the looks of it. Just soak it all in. I mean, they've soaked up about $100 billion. It's anybody's guess where the rupee would have been trading in the absence of that. Could it have been 65? Could it have been 55? I don't know. I don't know the answer. It's a counterfactual, right? $100 billion coming into the market. Nobody really knows where it would have gone. This year, obviously, it's different. Oil is at 60 plus. Your economy bounce till the most recent episode that we are living through. The bounce has been tremendous, right? I mean, everybody that one was talking to till about 4 weeks back was indicating that they've never seen it so good. I mean, I have spoken to many corporate senior folks who have told me that they haven't experienced this level of demand and they haven't experienced this level of pricing power in 10 years, right? So we were clearly in a bit of a bounce phase. In that bounce phase, again, the reverse of that story plays out here because you have a trade deficit, your imports grow at a faster pace than your exports. And so therefore, this year should be different from a demand supply of dollars perspective.
Yeah.
But overall, whether if treasury yields go higher, will that pull dollars back, etc.? I think ultimately it's going to be a function of portfolio flows and FDI because the trade numbers are more or less predictable between $12 to $15 billion a month, offset by services, exports, and remittances, etc. So you don't leave too much. Nothing would seem to suggest that there is any stoppage of those flows. But yes, the most recent period with pandemic and everyone reassessing growth prospects, you might see. But I would just say on the external front, I think we've never been as secure as what we are today. I mean, it'll take a very pessimistic person to assume that that's a source of risk in India right now because whether it's a function of months of imports, whether it's a function of external indebtedness to the size of reserves, whether it is simply the size itself. I mean, when you are at whatever 650, 675, if I include the forward positions also, somewhere at that band, the central bank controls the currency the way it wants to. It didn't let it appreciate last year. If it doesn't want it to depreciate this year, they can step in. The jury is out what their preference is. It's by empirical observation, one senses they don't mind a little bit of periodic weakness as long as it doesn't get unhinged. See, the thing about financial market, just as we spoke about bond market, is that once things get unhinged with all the good narrative I'm sharing, you can then get out of control because and that's what I think that's what the only thing I think they will try to control, unhinging of the expectations of the value. Otherwise, I think it's in their control.
Jayesh, even there were critics, and you can call us media people, we'll go find the problem spots. But there were enough people who were saying that the RBI is intervening too much, forward positions. And this last week or 10 days or so of rupee move, was it more linked to some of those factors than just, change in belief on macros or QE?
Couple of things. So I think one, of course, was very clearly, and they finally, since October we have been saying, but they said in one of the last policies also that basically till the fundamental of the country changes, if it is going to get appreciated by just your FPI flow, they're not gonna rupee appreciate, and that's what did the right thing by building up the buffer. That's one part of it. In terms of what's happening in last 10-15 days kind of situation, I think a lot of people had carry trade. I'm talking about offshore, and it has nothing to do with GSAP situation of 1 lakh crore. That was anyway known, right? Whether you do GSAP, OMO, whatever it is, it's now explicitly spelled. But even before that, governor has said like we'll buy 3 lakh crore we bought last year, we'll buy 3 lakh crore this year. So all that was anyway known. So it is just that the trade numbers are changing very differently, as Dave said, from last year to now. And then the carry trade, some unwinding happens. And when, when people build up position, everybody builds up at different time. Unwinding happens typically, unfortunately, in every market, more or less at the same time. And that happened more or less at the same time. And that's what we are seeing right now. And now, of course, it will depend on what happens to the FPI flow, maybe a weaker flow till we have this pandemic again resurfacing, Indian strain and stuff like that. We don't know how it's going to pan out in next 1 month or so. So we'll have to see how it pans out. And the FPI is going to reflect to that.